Most people think that the only way to make money in the stock market is by buying low and selling high. But that's only half the story. Even though nearly 60% of Americans now own stocks, few ever learn the other ways to profit. Earning income from shares you already hold, hedging inflation, and turning patience itself into cash flow. These options are powerful when it comes to achieving and sustaining financial independence. Yet these options are not taught and seldom spoken about. And once you know how they work, the market starts paying you, not the other way around. So today, I'll touch on many of my favorite strategies and how you can use them to better grow your portfolio, hedge inflation, create income streams, and glide your way to the finish line and beyond. Stay tuned. Welcome to another episode of Escape the Clock, the podcast where I, the author of the book, help you create a plan for financial freedom and the option to work on your terms. Last week, I did an overview of the stock market. Today, I'm going to go deeper, talking about different ways you can use that portfolio to make money. Now, if you've invested before, you're aware that at its heart, it's really just about hoping that your money is going to grow and that when you're ready to cash out, you'll have a positive return. And that's 80% of it. And hopefully some of the things I covered last week will help shine a light on how you can do that smartly. But what about when the markets are in a free fall, or when your income is at its lowest, such as in an early retirement, or when interest rates are on the rise and all of those hard saved dollars just aren't going as far? Well, there are strategies for all those scenarios and more. And I'll touch on many of them today so that you can be informed on ways that you can improve your plan. Because knowing that you're able to generate cash from a portfolio in an early retirement, well, that means you may not have to save quite as much and worry about withdrawals getting you as far. Again, I'm going to be talking about investing, so that's going to include some of our advanced strategies that I touched on last time. And please remember that when it comes to investing in stocks, that means risk, and past performance doesn't guarantee future results. Anything you bring into your plan really should be reviewed with a certified investment or financial planner. And I'll be talking about some new types of things, such as selling stock options through calls and puts. And that risk can be quite a bit higher than just normal stock trading. But some of the other strategies I'll speak about are actually lower risk, such as building a CD ladder. And I'll try to describe what level of risk I'm talking about when I introduce these strategies so that you can personalize your plan to your individual risk tolerance and goals. And before jumping in, I have to say, I'm really excited about this episode. This is exactly the kind of thing I wish someone would have shared with me when I was starting out. I stumbled in some of these things. I did them a little late, but luckily it's still early enough that I had time to recover. Being able to know these tools early means that you can optimize, and optimization can mean real dollars. So stick around and you'll see what I mean. There are ways to profit when stocks are rising, ways to profit when they're crashing, and the more tools in your tool belt, the more you're going to be empowered to leverage your portfolio to stretch your cash and investments to the max. So let's jump right in, starting with how to build up that portfolio so that you can get the most cash. Today's conversation is all about how to make money in the stock market without selling shares. I'll be covering 4 powerful strategies to do that. But first, before we dive into any of these advanced strategies, the first essential step is simple, and it has to be done first, which is building your portfolio. Now, that might sound obvious, but I promise you this step is everything, and it takes time, sometimes years, but it's the foundation that powers everything else that we're going to be discussing today. The stronger your base, the more powerful these tools will become. Think about it this way. Generating $50 for every 100 shares that you own with one of these tools is more than doable. And that's a nice bit of extra cash. But now imagine that you've built up 10,000 shares. Now you could be generating $5,000 every time that you do this. So the amount that we're talking about can really scale. but it only scales with the size of your portfolio. And for some people, they might need millions of dollars in a brokerage account to be able to do some of these for the amount of monthly cash that they need to survive. So keep that in mind. So with time, we can get there, but with that, you can have enough cash flow to make financial independence feel very comfortable. So let's get right into it, starting with the first scenario, which is how do you grow that portfolio using a really powerful strategy? So before we can tap into these big cash flow things, we have to build that up. And to do that, you should keep in mind some of the things I discussed last week. We spoke about smart ways to start investing, like using active versus passive strategies and focusing on long-term holding. And remember, holding for gains means letting compound growth work for you. So earlier you start, the better. Plus, holding for a year and a day means your gains are taxed at a long-term capital gains tax and not as an income tax. Doing this means you could potentially pay zero tax if you sell under the annual limit, which for single filers as of the year 2025 is $48,350. So if that were you, imagine that you built up this large portfolio and then you start harvesting $48,000 a year tax-free. That's actually really great money. And for a lot of people, that might be enough to live off of, but not for everyone. You might need more than that. But before we can tap that portfolio to cover the rest of your costs, we have to obviously build it up large enough so that you can harvest it and still have enough left over to get you that cash flow. So to build it up, though, the simplest way is to automatically buy a mix of ETFs, growth, and value stocks. And of course, getting dividend paying stocks that offer a reinvestment plan or a DRIP will speed things up very nicely. Just remember one key tax note here. In a regular taxable brokerage account, even if you automatically reinvest your dividends, those dividends are still considered taxable income in the year that you receive them. Basically, what I'm getting at is taxes always need to be a key consideration for you when you're building your portfolio and when you are even cashing it in. Okay, so the important thing here is that you're consistently acquiring new shares on an ongoing basis. And that takes time, but eventually you'll get to that dream portfolio. Just remember, smart investments mean research. Speak with financial advisors, use planning tools like the one on escapetheclock.com, or do your own online research, whatever you need to understand, be informed, and get ahead. And when all goes well, you'll see a nice spread of assets. And that's when the inner dialogue will shift from how do I get ahead to how do I protect this? Then you might be thinking, I'll just buy more ETFs. Diversification is smart. But that's not a silver bullet. Here's the problem. If the entire market is in a downturn, no stock is safe, no matter how many are in that ETF. No worries. That's where we get into this first tool, one that can help us prime that portfolio into a cash machine and protect it so that we can keep working for us. Now, in my book, I talk about this strategy quite a bit. It's called glide path investing. And it's one of my favorite strategies for building wealth that is resilient to the many risks that the market will throw at you. To picture it, imagine you're landing a plane. If you don't know where you're going, you'll be steering and guessing and fighting bad weather, and it can be a rough landing if you land at all. But if you know exactly where the runway is and you follow a smooth descent path, you glide in, calm, steady, and confident. And that's the idea behind glide path investing. So how do we create a glide path for a portfolio? It's not actually all that hard. It just takes a little forethought. Our lives have different phases. First is the working years. This is where our income peaks and our time is slowly diminishing. Eventually, we might get to an early retirement bridge phase. This is where we don't have that work income any longer, nor do we have any retirement benefits, but we have some time left to still make some moves. The final phase is the full retirement phase. This is when standard retirement accounts become active and benefits like Social Security or Medicare kick in. So to make a glide path, you simply adjust the positions in your portfolio for these different phases. It's really just that simple. Let's quickly walk through a hypothetical. I'll just tell a basic story for someone named Aerith, who is aiming to retire early at 45 and then start collecting retirement benefits at 65. First, Aerith is in her working years. This is when she's starting out. She starts at 25 and she's planning to work until she's 45. And during this period, she's really focused on growth. So these early working years, she has to figure out how to grow that portfolio. And so she goes really heavy into growth stocks. 85% of her entire portfolio is growth stocks. And the reason is because she knows she has time to recover if things go badly. She's using time as the special part of the equation. And as she approaches 45 and her work income is already peaked and is actually potentially even starting to decline, she starts to shift to her pre-early retirement mode. Now, this is where she's reallocating to protect what she's built. So she no longer needs aggressive growth. She needs protection. So she can start to shift away from that 85% growth stocks, downshifting towards more of like a 40% growth, and therefore moving towards more diversification, such as through a 50% ETF allocation, and even maybe some conservative positions with 10% in bonds. It might take her time to get there, but that's the point. You're gliding, so you're making adjustments as you go. She knows that she can sell a certain amount of her gains, harvesting along the way, but she can't harvest a lot because she has income. But as she starts to move away to more conservative things, she might take a little bit of a tax hit, but it'll be worth it because she knows if there's a downturn, she's protecting what she has. Now, when she hits age 45, she's going to enter a new phase of her life. This is her early retirement phase, and it's a bridge phase between her working years and when she takes full retirement benefits. Now, during this phase, she needs to go into a higher protection mode. So, and she's quitting her job. She's not going to have paychecks anymore. But because she's quitting her job and her income's going down, she can start to do tax gain harvesting at a higher amount. Basically, her ceiling has gone up for how much she can sell from her gains, which allows her to be more aggressive in her reallocations. So with her low income and selling up to the tax-free limit each year to help build up her cash reserves, she can start using different strategies, which I'll touch on throughout this episode. Things like investing in CDs or high-yield savings accounts for additional interest to create new cash flow where she loses the cash flow from work. And eventually her allocation will shift. She might see something like 50% in bonds, so a more conservative positioning, because again, she's just protecting. So between bonds and cash, she's going to feel more protected. And then she might not have much growth at all. Maybe just 20% of her portfolio will be growth towards the end. And then she can still have some ETFs in there to help balance things out, maybe a 30%. So 50% bonds, 30% ETFs, 20% growth. As she gets to age 65, things are really going to start to change. First of all, before she even gets there, when she becomes 59 and a half, she can start to dip into her retirement accounts. If she had 401k or a traditional or Roth IRA, she'll be able to start using cash from that instead of leaning so hard on her brokerage. But when she gets to 65, she's deciding to take full retirement. So she's going to start claiming benefits. And this is her full protection phase. Because she has Social Security and she has a lower cost of living, she needs to focus on safety. Her final allocation will probably end up looking something closer to 70% bonds and cash and 30% broad ETFs. Now, the numbers I gave here, these are not hard rules. This is based on your goals, your risk tolerances, your preferences. This just was a hypothetical for Aerith because, that's what worked for her. In her story, it shows you how and why a glide path can work. It's a gradual, deliberate, and it can be very automated. But with it, it's simple to stay calm and focused, avoiding emotional overcorrections like panic selling. So in summary, use time to your advantage in your working years. And as you get ready to leave work, shifting to safer assets like bonds or dividend-paying stocks or just cash equivalents. It's not really sexy, but it's really smart. So doing this, it means that you can have an easy path to land smoothly on that runway. This next scenario is about how to create easy early cash flow through something called stock lending. Now, eventually, you're going to have a large portfolio built up, but it can feel like your money's just vanishing into a black hole. Seeing your contributions compounding towards a distant goal that you can't touch, it can just feel like I'm just dumping money into this thing, but I'm not getting anything back out. I'm just going to have to be patient. And you might be wondering, is there any way I can make money from what I already own without selling all this? And if you listened to me last week, you instantly think dividends. And you're right, that's arguably the best way. But again, we would like to leverage that drip, reinvesting into shares, at least until we can start getting to a place where we're more comfortable to take the cash. Luckily, there is another tool that many investors overlook, and one that is really easy to get cash payouts, which is stock lending. And here's how it works. When you lend your shares, usually through your brokerage, you're letting another investor, often a short seller, temporarily borrow your stock. In exchange, you're earning a small lending fee, usually a percentage of the stock's value, which gets paid daily while your shares are out on loan. The best part here is that you still own your shares. You can sell them whenever you want. You just earn a little extra cash for allowing access to them. Now, most brokers offer a stock lending program, and it's easy to opt in. If you have a lot of shares, especially of like a hot stock, you can quickly start generating daily interest. This will then be paid out as cash each month into your account. It's pretty great, but there are a few things you absolutely need to know. First, while your shares are on loan, the borrower will get voting rights. Maybe not a big deal, but something you should be aware of. Next is if the stock pays dividends, those payments go to the borrower. The good news is that most brokers will still pay you the dividend through a substitute payment. So you get both interest and dividends. However, the substitute payment is often taxed as regular income instead of qualified dividend income. The other risk is that and actually maybe the largest risk, is that the loan shared may not be covered by SIPC insurance. Your broker holds cash as the collateral, but you really do need to be aware that counterparty default risk is a possibility. Finally, the people borrowing your shares are likely doing so to bet against your stock. That last point might be a deal breaker for you, to be honest, and that's reasonable because ultimately that might not be a problem though. And what I mean is, as long as you believe in this company's fundamentals, the one you're investing in, then knowing that someone's trying to short it doesn't really have to matter because the shorters, they're taking on a short-term risk. They're looking to make a quick profit. You, on the other hand, you're trying to earn passive income and hold for the long term. Just keep in mind, stock lending, this is not a get-rich trick. It's a low-effort option that can just turn on some cash flow early and create very small, consistent gains over time. The next scenario is about beating inflation and locking in returns. And look, inflation is one of those words that we hear all the time, but most people don't grasp what it means until it actually hits our wallets. And the simple version is this. Inflation is when prices rise and the value of your money shrinks. And over time, that same dollar that you have will just buy you less. So if a basket of groceries cost you $100 last year and inflation was 3%, then if you went and bought that exact same basket of grocery this year, you would spend $103. Over a decade, that 3% inflation rate means that your cost could jump nearly 35%. And that is the quiet power of inflation. It slowly eats away at your purchasing power. It's like trying to walk up a downward moving escalator. If you're not walking faster than the escalator is moving, you're going nowhere fast. So ignoring inflation can mean running out of money. For example, let's return to Aerith. Let's say she earned 10% returns her first year as she was building that portfolio. Well, she might be really excited about that 10%, thinking she did great. You know, that's a really good return for a year. But the truth is that was her nominal return. If inflation was 3% that year, you have to actually deduct that. And so her real return was actually only 7%. If she were to ignore future inflation, she might be even thinking she's hitting her big financial goals, when the truth is she's actually falling short. She could run out of money. So the risk is real, and you need to really consider inflation when you're calculating numbers. And I have this all in my book. I outline projecting inflation, understanding it, trying to ensure that our goals are inflation adjusted. Because if we don't do that, then we're not being honest about how far our money can take us. So you might be thinking, how do I deal with this? I need to make sure I'm getting returns, that's for sure. I want gains. I also like to make sure that I'm able to generate some cash. So to deal with this, you need to lock in interest that can beat inflation. It's really as simple as that. So interest rates need to beat that percentage of inflation per year. So for Aerith, that inflation was 3%. She really needs to make sure that she's getting at least 3.1% or higher to make sure she's getting ahead. And this is exactly why normal savings accounts are so problematic. If your APY is 0.5% and inflation is 3%, That means you're losing 2.5% every year. That savings account would actually be hurting you, not helping you. And that's why I'm such a fan of the high yield savings accounts, or the HYSAs, because at least there, normally your cash can keep up with or even slightly beat inflation. So be honest, look at your interest rates, make sure you're able to do that. So in Aerith's case, she might decide to move away from her savings account because she might notice that, hey, inflation's something I got to care about. She looks, she sees she's getting a 0.7% savings account rate, and she decides to shop around, looking at credit unions, banks, even maybe money market accounts, to try to find anything that's paying something higher than that 3% that she's seeing for inflation. And she might decide to move to an FDIC insured HYSA. That means her money is insured and protected, and she is able to get a starting variable rate of 4.15%. This is allowing her to keep her cash liquid while immediately boosting her returns. So now she knows she's getting ahead. So beating inflation long term, it requires more than a good bank account. It actually requires a plan. And the main protective technique is actually this thing called hedging. So think of this as a kind of financial insurance. It means making an offset investment to protect yourself if the price of another asset moves the wrong way. So, instead of putting all of your money on black, you put some money on red, you're hedging your bet, that kind of thing. So if you think that one asset might fall, you want something else that might rise or at least hold steady. And to do this, I'm going to cover a few options. First are bonds. These are the traditional hedge, and they often rise when stocks are falling. So you see this very often when people are worried about stocks starting to dip. You'll see that they're moved to bonds start going up. And this is great. They're protecting against volatility. But there's a catch here. If inflation spikes, the thing that we're actually trying to hedge, then all of those fixed income bonds, they lose value very fast. So what you see is they'd have diminishing returns in an inflation-focused market. Well, there's this other thing called TIPS, Treasury Inflation Protected Securities, TIPS. These are actually government bonds that are designed to move with inflation. They're inflation-focused bonds. And their principal, which is the amount that you put into them, they actually get adjusted based on the consumer price index. And that index, that changes with inflation. So when inflation rises, so does the amount of money you would put into it. It gets automatically adjusted, which is actually pretty cool. So this is one of the purest inflation hedges available. So if you're just like, hey, I just want to hedge inflation, what do I do? TIPS is probably the thing for you. There are also things like gold and commodities. You might hear this come up quite a bit. Gold, for instance, will hold steady when everything else seems to be uncertain. This is where people typically look to when uncertainty is on the rise. They feel more safe in gold investments. It doesn't generate income, though. It's just a store of value. So that's something to keep in mind. And then there are things like crypto. In practice, crypto has behaved more like a high volatility tech stock than a hedge because it's a speculative asset. So far, it's not been proven to be a reliable hedge, but a lot of people believe in it and see it as the future, as a digital currency, that it could be the smart place to go. So something to look at and keep in mind. And look, all of these, they all work differently. There is actually no perfect hedge. So what you need to do is understand that each of these serve a time and place. They're just tools, and that you can balance and mix them based on your goals. So for Aerith, she puts a plan in place to react based on the market conditions. She decides she's going to invest in gold when the US dollar is weakening. She's going to protect gains with TIPS when inflation is climbing, and she'll invest in bonds when her stocks are most volatile. This flexibility in her plan, this is keeping her portfolio cash strong. And that's the point. We're trying to keep our returns strong, make so we can get further with our dollars, and that ultimately we're always getting ahead. Now, when Aerith enters her early retirement, because remember, she had a bridge phase, these simple protections aren't going to be enough. Like, these are hedges, these are protections. What she might need, though, in an early retirement is a guaranteed rate of return that's also giving her cash, actual cash flow. And that is where certificate of deposits, or CDs, come in. If you're not aware, CDs, these are one of the simplest, safest investments there are. What they do is they lock in an interest rate for a set term of time. And at the end of that period, you get all your money back plus any interest. Plus, they're actually insured. They have FDIC insurance up to $250,000, just like the money you would put into a bank, making them as close to a guarantee as you honestly can get. A bank can't guarantee you an interest rate, but a CD can. Now, the downside here is you're getting a loss of liquidity. If you put money into a savings account, you can take it back out anytime. There's no penalties. It's easy. Now, with the CD, that's not true. You actually have to keep it in there for the amount of time you're agreeing to keep it in there. It gets locked in. Now, you can take it back out, but often you will pay a hefty penalty fee. Also, if rates change, such as rates get better, well, you're stuck. You have a static rate in there, and you might feel like you're losing out. So Aerith actually makes this mistake initially herself. She has $10,000 that she wants to ensure is generating some cash for her, but also hedging any type of interest rate changes. So she locks that $10,000 into a 12-month CD at a 4.25% interest rate, which is pretty good. And 3 months later, she sees that the rates jump, though. They jump to 4.5%. But she's still in there. She still has 9 months left in her CD at 4.25%. She might go, oh, I'm losing out on 0.25% now. I need that money back out. I need to move it. But she can't, not without paying a penalty. Guess what? There is a strategy here, one I talk about a lot in my book, and one that can create even better cash flow, which is called the CD ladder. So instead of putting all of her money into one CD, she divides it across several with staggered end dates. So she might pick a 3-month, a 6-month, a 1 year, etc. These are the rungs of the ladder. So what we're doing is we're always climbing up the ladder. When one of the CDs ends, we create a new one, which creates another rung in the future. And so what that looks like for her is when her 3-month CD ends, she rolls the principal and the interest into a new longer term CD at the current new best interest rate that she can get at that moment. This is how she's always freeing up capital to capture the new better rates. So now Aerith is capturing better rates as they arise, and optionally she can use the interest as a cash flow stream to cover her expenses. So as each one of these CDs ends, the 3-month, the 6-month, so on, she can keep that interest to spend and then just reinvest the principal into a new one. And that makes the CD ladder one of the most powerful strategies for creating predictable, stable cash flow in a retirement. So the key takeaway is this: inflation's inevitable, but being prepared is not. So try to understand the tools and make the right moves, and you'll be able to get those better interest rates and stay ahead. The last scenario is the big one. Now we're going to talk about generating serious cash with options. We've talked about building and protecting a portfolio so far and generating cash flow through dividends and lending and CDs, and that's all good. But now I want to talk about pumping a portfolio that you built for serious cash. This leads us to one of the most powerful but often misunderstood ways to create income, which is stock options. Now, when most people hear options, they might think high-risk trading or gambling. And while they can be used for speculation, they are fundamentally tools that, when used conservatively at least, can provide steady, predictable cash flow without even selling a single share of stock that you own. They can be very powerful when you know what you're doing. Now, what is a stock option? It's simply a contract. You're creating a contract, which is an agreement about a possible future transaction. And so I'm going to cover a couple here. The first is a call option, which is where the buyer has the right to buy a stock at some specific price. This is called a strike price by some set date. So a call option is about buying a stock, and then a put option will give the buyer the right to sell a stock at a specific strike price by a specific date. So we have call and put options. Now, we're going to talk about the selling side because that's how we're going to be generating cash here. You can buy options, but that's not the focus here today. The focus here today is how do we generate cash from a portfolio we built up, which allows us to generate something called premium from our shares and from any cash that we have in our reserves. So when we sell an option, you're the one collecting a non-refundable upfront fee called a premium. Basically, this is money that goes in your pocket that you get to keep no matter what. When you're selling a call, You're agreeing to let your shares go at a price that you set. If the stock doesn't actually hit that price, that contract that you went into, it actually expires, completely worthless to everybody. Nobody wants it. And so you'll end up keeping all that cash that you got paid, and you keep your shares. That's the money-making strategy that we're going to get into. The other way, though, is selling a put. You could actually agree to buy new shares at some price that you set, maybe a discount. You say, I'd buy some shares, but cheaper than what they're at. Now, if the stock doesn't drop to that price, again, the contract would expire worthless. So you would actually keep the cash you were paid for going into that contract and not be required to buy any of those shares. So you didn't spend any money, but you made some money. As you can imagine, when done well, you'd be collecting cash using your portfolio as leverage. But please be aware that selling options involves greater complexity and risk than simply holding stocks. This is a much higher risk strategy than anything else I've ever talked about on the show. You even have to have special permission from your broker, and you really do need to understand the mechanics fully. I recommend you start with paper trading, which is simulated trading, before you ever try to trade money or go into a contract. This will help you understand how the markets can move and what the different parameters mean and things like that. So definitely I would recommend at least a month of paper trading, if not longer, and try to track and understand what's happening and improve your approaches. And to be honest, this is just not for everyone. Not everyone should think about this in their plan, but you might be someone who goes, okay, I'm going to take it seriously and I think I can do well with it. I personally have it in my plan and it's done well for me. Let's go a bit deeper how this works though. First, I want to start with the call side, and we're going to talk about something called covered calls or CCs. Generally, this is the most conservative strategy. This is where if you own at least 100 shares of a stock, you can sell a call option against those shares. So every 100 shares can be one contract or one call. Now, every time you sell one of those contracts for 100 shares, you get paid a premium. So you might sell one contract for $50, or you could sell at volume. You could sell 50 contracts at $50, which would then net you $2,500. And no matter what, you keep that money, no matter what happens. So how do they determine that $50 that you might have got paid, right? In the premiums, you'll see that when you're creating your contract. There's a bunch of different kind of offers out there, and you can kind of figure out how much you might get paid. Well, it's based on two things. First is that price that you're setting, the strike price. This is the price you're willing to sell out. And this sets the intrinsic value of the contract. Basically, when you're willing to set that price far out of the money, or OTM, meaning you're setting that price further away from the current market value of the stock, you're going to get lower premium. What I mean is the chances of the contract going through will create more value in the contract. So if you keep the price close, you can actually set the price under the current value. That's called in the money. You could set it at the current stock price on the market of the day. That's at the money. Or you could set it out of the money. So over. The further away or over that you set it, the less you'll get paid. The closer you set it, or even under, if you do in the money, the higher the premium you get paid. Is very valuable to people because they're like, oh, this is extremely likely to go through. This person is basically saying they're going to sell me their shares at a discount. I'll pay them a lot of money for that, right? So that's what you'll see. But that's not the only thing that sets the premium. The duration, or how long you're willing to allow that contract to exist, that can change the premium as well. The longer the duration, the higher the premium, because there's more time for the stock to move. Basically, what you'll see is uncertainty plays a big role here. So when they're high volatile stocks, ones that move up and down and big swings, you'll see premiums are really high for those because the risk is really high of them going through. These are things to keep in mind. So the primary risk here, though, is that by selling a call, you could be capping your potential profit. Let's say the stock stays below your strike price. Then you keep your shares and the premium. That's a winning contract for you. You got paid for creating the contract. The stock never got to the price you set, meaning it's worthless to people. They could just buy it cheaper on the market. They don't need your contract. They don't want to overpay for it. So your shares are still yours. But what if that stock skyrockets past your strike price? Now you are offering an extreme discount to people, and your contract will become very, very valuable. And you'll be forced, because you signed a contract. You have to be good for this. You have to sell the shares at the price you agreed upon. And you can miss out on a lot of upside there. If the market moved way past, you could be selling at an extreme discount, meaning you missed out on way more money than you got in your premium. And that's the risk. So be aware. That's why this is a higher risk strategy. Now, Aerith, for example, she's in early retirement. She's interested in trying options. So what she decides to do is start selling some conservative calls on her hundreds of shares of the Pika stock that she owns, PIKA. And she's able to generate a $90 premium for these contracts. Now, if Pika rises above her strike price, then her shares are going to sell at that locked in price. She'll have made money, but she'll have maybe missed out on a bigger gain. So to maximize income while keeping her shares, she can pursue a strategy of selling conservative contracts at volume. So this is actually what I do. When you build up a big portfolio, you might have a lot more shares. What you can do is sell contracts that are far OTM or out of the money. You want the largest distance and strike price as possible, even though it means lower premium. So instead of a contract for $200 close to the money, she might sell 10 contracts for only $20 each. She's netting the same amount of money, $200. But what she's done is she's greatly increased her chance of keeping her shares. And if she repeats this maybe every week, she could be generating thousands of dollars a month. And that's the power of covered calls. Okay, there's actually an inverse to this though. I just touched on covered calls. Now I'm going to touch on the other side of the coin, which is cash secured puts, or CSPs. This is where you're leveraging cash that you have on hand to earn premium by saying that you might possibly buy shares at a discount. And this is a really interesting tool. So you can sell a put option instead of a call option, which I talked about before. Now I'm talking about put options. So you sell a put option on the stock that you want to own. You don't even have to have any shares here, because remember, that portfolio can start to turn into cash. Well, you can generate cash from your cash. So here what you're doing is you're setting a price that you'd be happy to pay to own that stock. And you're getting paid a premium up front for this contract. And the money you need to buy that stock, so the actual cash value as if the contract ended and you're forced to buy it, that amount of money gets held by your broker as collateral. That's why it's called a cash secured put. You're guaranteeing you can afford to pay for the thing that you're signing a contract for, so they hold it for the time that you have the contract, a week, a month, however long you set the contract up for. And if it goes through, they'll actually use that cash in collateral and they will buy that stock. You're actually forced to buy it, maybe at a higher rate than what the market was if it dropped too far. So it's the inverse side. So that's the key risk here. If the stock price drops far below your strike price, you are obligated to buy the stock at the price you agreed to. And that's why you must only sell CSPs on stocks that you are truly willing to own. You should feel really good about that price you set. Go, wow, I would love to have 100 shares or however many contracts you're selling at that price. That would be amazing. If you're doing that, then you're getting paid for the possibility of getting the thing you want and that you're trying to work towards upside. Now, if the stock stays above your strike price, of course, you're just getting paid and you're not forced to buy anything. It would be up to you if you want to go to the market and buy it yourself. Of course, if it falls, you're forced to buy the stock you wanted, and the premium will lower your net purchase price. Now, the beauty here is that calls and puts can actually work together in something called a wheel strategy. This is the thing I like to do. So this is a continuous cycle to generate consistent cash flow. So to do this, what you do is you start with a cash secured put, or a CSP. So you sell a put on a high quality stock that you would really love to own. Now, if the stock stays up, then you just keep the money you made, you keep the premium, and you do it again. Sell the same CSP, maybe, you adjust it based on how the market moved. But if the stock falls and you're forced to buy the shares, that's no problem. You can move on to the next step, which is now that you own shares, again, you bought at least 100, it depends on how many contracts you had. Now you can start to do covered calls on those shares. Let's say you just bought one contract worth, so you got 100 shares of some stock. Now you go ahead and you sell a covered call and make some premium against that. Now, if the stock stays down, then you just made that premium and you can sell another covered call on it again next time. And you repeat as long as that continues. Once the stock rises and hits your price, your shares are going to get sold for a profit. You're getting assigned, which means you're going to be getting the cash back at more than what you originally bought in at. And now you can start doing CSPs all over again. And that's the wheel. So this is kind of a strategy for buying low, selling high, and generating cash along the way. And this strategy, it can generate consistent income, but it is a higher risk approach. Please don't listen to me and think, oh my gosh, this is like the infinite money glitch. It can feel like that sometimes. It really can, especially when implemented conservatively on high quality stocks that you would really be happy to own. The problem though is, again, you can lose out on potential upsides or downturns. It can hurt you when it swings too far one way, and it can hurt you when the gains go too far the other way. Keep that in mind. The conservativeness helps mitigate that, but there is never a guarantee. Still, the wheel can be a powerful income machine when used properly. So look, these aren't about trading. The options are really about control, patience. It's about intentional design. You do it very deliberately. Let me break it down a little bit. So we've covered two types of options and everything, but there are a couple ways when you have that big portfolio that you really can generate real cash, especially in early retirement when you don't have a paycheck. The first is dividends. Dividends are just paying you on an ongoing basis for owning shares. Covered calls will pay you for agreeing to sell those shares. Cash secured puts will pay you for agreeing to buy new shares. And then the wheel will tie them all together. And once you understand that using options is about monetizing patience, you will feel like you've cracked the cheat code on the stock market. It means that all that hard work of building up that portfolio was for so much more than just the gains. I covered a lot today, but that's because there are so many ways to generate money from a good stock portfolio. The beauty of all of this is that you do not need to do any of it. Just pick what makes sense to you, because everything I mentioned here is on top of just buying and holding for gains. That's the minimum. You could absolutely just do that. If there is one thing I hope you take away though, it's that true wealth is not just built from what you buy, built from how you manage, protect, and use what you already own. When your portfolio starts working for you, earning dividends, lending shares, layering CD ladders, selling covered calls, or even just hedging against inflation for better returns, that's when you begin to feel the difference between investing and true financial independence. And as you approach your freedom point, whether that is early retirement or later in life, your focus shifts from pure growth to maximizing income and protection. And that's when new tools and strategies are unlocked. So just to recap, investing on a glide path can be a great way to smooth the descent to your goals. If you've ever seen a target date fund before, these things like a target 2055 fund, you might see this in like a 401k or a 529 account. This is actually that concept in action. These funds, they start aggressive early, and then they gradually become more conservative as you approach those dates. So the glide path is a real strategy, and it's being used in many different places, and you can use it for yourself. You can personalize a path way better than some static fund, especially when you know what you're doing. So, and that's the beauty of it. That's the beauty of the glide path. It's not about timing the market. It's about preparing for it. And returns are important, but so is protection. I talked about Aerith earlier and how she was doing a glide path, but imagine she hadn't done it at all. Imagine she had built up $600,000 in her brokerage account through all those growth stocks, and then the market dropped 30% right before she got to her next phase of early retirement. Her portfolio would have fallen to $420,000. That could have meant a delayed early retirement or not even having one. So this is a big deal, and it's worth thinking about, because some people will say, well, growth stocks could grow forever. I don't want to miss out on that upside. But there's no guarantee they'll grow forever, and there's still upside as long as you're beating inflation. But because she did shift and protect her wealth, she had moved away from growth stocks. But let's say she'd only gone 50-50. Well, that 30% drop on her $600,000, instead of dropping all the way to $420,000, would have dropped to $510,000.
That's a $90,000 loss instead of a $180,000 loss. And that could make all the difference. Recovering from $90,000 could have been doable for her, maybe a short, delayed early retirement. With a strong portfolio and all those shares that you've amassed, you really do start to untap new cash flow options for yourself, especially through dividends, CD interest, stock lending, and stock options. Those are the strategies I've covered today. There are more than that, but those are the ones that I find can really help you architect a really amazing plan for yourself. Dividends and stock lending in particular are truly passive income. It's just cash that's just popping in. You're not doing anything on the stock lending. It's automatically lent out. The payment comes to you. You don't have a lot of control. You can't pick what's getting lent and you can't pick the interest rate, but you do have cash coming in. Same with dividends. You're not setting the ratio, but you can control how many shares you're buying. And that passive income can feel really, really great, especially when you no longer have paychecks. The CD ladder, that can give cash flow while locking in rates. That one can actually solve multiple problems because market risk, they'll eat into your returns, especially inflation. So combining tips with a CD ladder, diversification, maybe some gold exposure, that can help you cover most major risks. It can feel really great to create a system that's growing when times are good, protects when times are bad, and quietly keeps your real wealth intact, especially when you see other people are frustrated and losing ground to inflation. And when all is said and done, you might decide to untap the power of option trading. Just understand the risk, because it is higher risk with a higher reward. Start with paper trading, then start with small trades. Don't trade anything critical. Work your way up. When mastered, those years of accumulating shares can now really be put to work for you, though, generating extra cash flow. And that's how you move from being an investor to being an architect. You're not just participating in the market anymore. You're designing a portfolio that funds your freedom and sustains your peace of mind. Okay, if you enjoyed this episode, head over to escapetheclock.com. I have free tools to help you build your glide path, help you track your income, and apply a lot of these strategies at your own pace. Or even better, share this with someone you care about. Every financial move starts with education, so share that gift with somebody. They will appreciate you for it, because mastery does not come from knowing the names of these tools. It comes from knowing when and how to use these. And before we end, I want you to know that I did not even cover everything I could have today. Futures trading, margins trading, shorting. There are additional ways to generate cash from investments, but these are all considered advanced for a reason. They are high risk and can result in financial catastrophe if done poorly. I briefly cover these in my book, and I am happy to do a part 3 episode if there's interest. Just leave me a comment on the show page or email me and let me know. Remember, the goal is not to trade consistently or chase hot stocks. It is design a system that can grow when times are good, endure when times are bad, and pay you along the way. Before we wrap up, I would love to hear from you. What ways are you most excited to generate cash flow from your investments? Share your stories in the comments. Thank you for listening, and best of luck pumping cash from your investment portfolio and escaping the clock. I'll see you next week.
Thanks for tuning in to this episode. Remember, while I'm not yet a financial planner, I am getting my degree in wealth management. You should take anything you've heard here as tips and advice to making your plan. To learn more, visit www.escapetheclock.com. There, you can find the book, resources, including the planner, and you can even schedule time with me. Please remember to like and subscribe so you don't miss an episode. Thanks for tuning in, and I'll catch you next time.